Welcome to Creamer Media's Polity. I'm Shannon Derehove. Siraj Mohammed from the Wits School of Economic and Business Sciences is in the studio to discuss his views on the 2011 global economy and what South Africa can learn from it. Welcome, Siraj. You argue that as South Africa joins BRIC, we could learn from their economic policies, a better way of engaging globalization. Could you elaborate on this?
Yes, I think China is probably the best known example of a country that is integrated into the global economy on their own terms. But we see that the other BRIC partners have also chosen not to follow orthodox economics and economic thinking in the way they've integrated. And they all use a measure of state control and regulation of both trade and financial markets. We see in China, for instance, that they've managed to get a huge amount of foreign direct investment, and they have a very liberal approach to foreign direct investment, but they have a very tight control of short-term capital flows. And so in terms of exchange controls and capital controls, the Chinese economy is very tight, and they've managed to actually maintain a stability which other developing countries like South Africa have not maintained, because they control how money enters and exits the country. And so they don't have the the kind of volatility in their macroeconomic variables that other developing countries that have fewer controls do. We saw last year that in the light of the crisis, and also then seeing more flows, capital flows to developing countries, that Brazil put in place controls. We saw most of the Asian economies. We see Russia taking more tighter control of capital movements as well. And all of this is partly related to the volatility with the exchange rate. And that filters through the economy. It affects how, whether you attract more flows into the economy or what your interest rates will be, and those kinds of variables. And from the 1980s, there's been a big push through what we call the Washington Consensus. The World Bank, the IMF, the US State Department, all based in Washington, agreed that developing countries should follow a certain kind of economic policy, and they would support them and give them aid if they followed those kind of policies. And those were what we refer to as neoliberal policies. Basically, a smaller role for the state, liberalizing of financial markets, reducing tariffs, liberalizing trade, privatization, and those kind of things. Basically, arguing that the market should be left itself and that the state should stay out of business and just create a facilitating environment. To a large extent, South Africa followed the Washington Consensus advocates in what they did. And what we found from the 90s especially were that many developing countries had a financial crisis. We saw that financial markets in the developed and developing countries were growing out of control, and that we were seeing more regular and the financial crisis getting worse until the most recent one. And now I think there's a developing consensus amongst mainstream and less orthodox economists like myself that the way in which we integrate into the global economy needs to be managed. And we see that countries like Brazil, India, and China have actually not been as severely affected by the financial crisis. They managed to rebound quicker. And South Africa is still sort of limping along. We sort of haven't recovered those jobs we've lost. We actually may still lose jobs this year. And I think it's because we haven't integrated the world that way. And I think as we become part of that BRIC group, there's a lot we can learn from those countries.
Now, you suggest that the narrow focus on inflation targeting should be replaced by a focus on asset price stability. Why do you suggest this, and which asset prices are key?
Well, what we've seen with global financial integration is that when lots of short-term speculative flows, financial flows enter a country, they often push up your stock prices and your real estate prices. And this was the case in Mexico in '94, before '94, when they had a crisis. It was a crisis in countries like the Philippines and Thailand before the Asian financial crisis. And we've seen it happening in South Africa in the 90s, but especially after 2002, we saw a big inflow of short-term speculative capital, mostly into our stock market. and some into our bonds market. And these actually then enter the economy through allowing increased private access to credit. And we saw that from 2002 to 2008, around about the time the crisis hit, that the private sector credit extension of credit to the private sector increased by about 22%. The fixed investment by the private sector increased by 5%. The rest of that credit went into debt-driven consumption, people buying more homes, people buying second and third homes, starting to speculate in asset prices. We saw the listed real estate companies were booming. We saw other bubbles forming in our stock market. And so what happens when all this money enters your economy is that it can actually end up going into the wrong kinds of things that form these bubbles. And once you have a bubble forming, it's easy to have a crash. It's easy for people to take that money out of the country. So those are the kind of financial assets that we actually should monitor the prices of. And we can actually tailor our macroeconomic policies to make sure that we don't have those kind of bubbles. But we can also put in place ways to manage capital moving into the country, and especially short-term speculative capital. I think we should be promoting foreign direct investment and long-term capital coming to the country as much as we can, the way China did. But we need to manage those shorter-term flows, especially when people are coming to take advantage of the difference in interest rates, the carry trade that they refer to, when people are looking for higher returns in the stock market, which drive the bubbles, and then we end up with crashes, and then we end up losing jobs and being more in debt. So what's happened since the 80s again with the Washington Consensus, there was this belief that the main role of central banks is to keep inflation under control. And all the research from economists, mainstream economists, the works that the central banks did was focused on how you actually maintain inflation at a low level. And while this was happening, the financial sector was growing, it was being deregulated, and you actually had a huge amount of activity in financial markets that were very destabilizing to economies. And that was the form in which that comes out is these bubbles and crashes. And nobody actually was thinking about how do you actually maintain a stability in the economy when you have financial assets and real estate asset bubbles and crashes. So I'm not saying that we should ignore inflation and CPI and those kinds of things. What I'm saying is that the central banks and the Treasury, for instance, have been focusing too much on one tool and not on other things. And lots of our problems in the economy, lots of problems in the global economy, the financial crisis, happen because of these financial asset bubbles.
And finally, what do you think are the chances of a double dip recession, and what could drive us in this direction?
Yeah, I think we're still not in the clear. Many economies are performing poorly. There's very little job growth. We saw recently in the US economy there was actually increased number of jobs. But what we're finding is that even in countries like the US, and I think it's happening in South Africa as well, these are precarious jobs. These people are actually who lost their jobs during the crisis are now taking lower wages. They're working as casual workers or on short-term contracts. And so it means that any shift in the economy, any kind of decline, those people will be the first to lose their jobs again. We're seeing the ongoing problems with Portugal, Ireland, Greece, Spain, and I think even the UK and the US are still, not in the clear. And so all these countries have serious sovereign debt problems, and that could get worse. I mean, at the end of last year, we learned that countries like Ireland and Spain hadn't been as forthcoming about the levels of debt they actually have. Lots of them have been covering up. So there may still be more bad news coming out of those countries. Then what we're also seeing, and there was a warning about this from the World Bank recently in the economic outlook for the year, that all these speculative financial flows to developing countries pose very real dangers, and the kind of problems I spoke about earlier, asset bubbles in real estate and financial markets that could lead to crashes. And so we may end up actually finding a developing country having a crash. And we saw the danger that Dubai posed last year, and we could end up with another developing country having a crash, and that causing the kind of seizing up of financial markets we saw earlier during the financial crisis. So there are many factors, and there are lots of uncertainty. And my column was all about the uncertainty facing the global economy now in countries like South Africa, who have operated and have actually liberalized and become more integrated in the global financial markets. And I think the part of how we deal with that is to look at how we actually stay involved in trade and actually financial activity in global markets, but we protect ourselves from contagion and volatility. And that, I think, the answer is actually managing the way in which capital enters and leaves the country.
Well, thank you very much for your insight.
Thank you.
That was Siraj Mohammed discussing his views on the global economy in 2011.